Hey everyone, my name is John Kutzmita, and every week I record a podcast with my friend Brent Johnson that we call Milkshakes Markets Madness. I just finished recording this weekend's episode, so please go check that out. It'll be available Sunday. Now, the reason I'm recording this video is I used to do consistent videos, or at least semi consistent videos, for my clients about what was going on in the real estate market and specifically the mortgage world, the mortgage bond market, and the things that drive mortgage interest rates so people can make more strategic decisions about their real estate purchases and refinancing and all the things around their homes and the properties that they own. So I wanted to jump on here real quick and perhaps kick off a renaissance or resurgence of those videos and those conversations I used to record by talking about something that I believe will soon be a very hot topic for everybody in the finance and real estate space. And these are the rumors that Freddie Mac, which is one of the government sponsored enterprises or entities that went into receivership after the global financial crisis in 2009, that securitizes and packages up all these mortgages into mortgage backed securities. Now, Freddie Mac and Fannie Mae are two of the big names that you're probably familiar with. There's another entity, Ginnie Mae, and they're involved in government loans like VA and FHA. But what was recently leaked, if you will, or at least mentioned by Freddie Mac, is that they're looking for approval to start doing second mortgages. Second mortgages might include fixed rate second term loans, which is very similar to what your most people's fully amortized mortgages are. A term loan would have a fixed term, whether it be 15, 20, 30, and that your payment would be fully amortized, meaning every month there's a portion that goes to principal and interest. Now, those second mortgages could also be HELOCs or home equity lines of credit, which is a revolving line of credit or revolving loan versus a term loan, meaning you might have a length of time that you can use that loan, say it's 10 years, 15 years, but you can borrow and reborrow again off of that credit line whenever you need it. HELOCs are very, very popular, but there are certain risks involved when you're taking a second lien position or a subordinate position as a lender to a first mortgage. If there's any kind of default, foreclosure, and that property gets liquidated to pay off those debts, the first lien holder is going to be made whole or have their debts completely paid before the second lien holder is going to get a single penny. But when you get into an environment where the second or where these second mortgages are being securitized by the same entity that was involved in securitizing the first mortgage, which in this case would be Freddie Mac, then you kind of perhaps reduce some of those risks of not being able to recoup all of the funds that you've lent out. In addition, I think their goal is to keep the combined loan to value. Loan to value is the ratio between the balance or the outstanding debt to the property value. Combined loan to value would mean the LTV of both of those loans together. So if they keep the CLTV at a reasonable level, let's say 70, 75%, you would have to have a deeper correction than that 20 to 25% before Freddie Mac or whoever is involved in securitizing and managing that loan would start to be in some kind of financial trouble or at the risk of having to do some kind of write down on that second mortgage debt. So that's one of the things to keep in mind when you're hearing this conversation. Number one, what kind of loans are these going to be? They could be fixed term loans or they could be open lines of credit, revolving lines of credit like a HELOC. How are they going to be presented to the market? I think they're going to be limited based on certain CLTV. And I think it's going to come down to whether or not Freddie Mac is the one that is securitized or holds the mortgage on the first. And there's more things to understand when I use terms like hold the mortgage on the first or owns the mortgage. It's a little more complex than that. Let's not get too deep into those semantics. Just understand if Freddie Mac is not associated with that first mortgage, most likely you're not going to be able to get one of these second mortgages. The other thing to keep in mind here, which I think is hugely important, is the lack of liquidity in the market and or the inability for a lot of people to access equity at a reasonable price because of what interest rates have done over the last 2 years. Keeping in mind, the Federal Reserve has raised their overnight lending rate by about 5.5%. What the Fed does with the Fed funds rate has much more of a direct impact on credit cards and these other types of lending vehicles like HELOCs versus what actually drives first mortgage rates, which is primarily dictated by the mortgage bond market. So in the beginning of 2022, before there was any decision made by the Fed, there was an opportunity there where the bond market and the capital markets overall were able to kind of sniff out the fact that inflation wasn't going to be transitory and that the Fed had miscalculated and that there was going to be an inflationary problem. And so investors started selling bonds very aggressively. And as a result, the price of those bonds fell and mortgage rates increased pretty dramatically starting in right around February 2022. This is way before the Fed had made any rate hikes. The first time they actually raised the Fed funds rate from 0 to 25 basis points was in March. And the first time they really made any kind of significant moves wasn't until July when they did a 0.75% move after we got a 9% CPI report, which is the inflation report. And at that time, that was almost a 40-year high in the CPI. So the point I'm making here is before the Fed had actually started raising rates, the mortgage bond market had already figured out inflation was going to be a problem, and mortgage rates on first mortgages had started to rise. The second mortgage market had a sweet moment there, a sweet spot between March and say July, where you could go out and get a HELOC or second mortgage loan, which are generally based on the short-term lending rates like the Fed funds. You could go out and get that second mortgage at a decent rate, maybe it'd be 5 or 6%. Well, now that's completely changed. A lot of these HELOCs are 9, 10%. If you're looking at term loans in the second mortgage space, you could be looking at somewhere between 10 to 15%. So although that does provide some sense of relief if you're paying 30% credit card debts and want to consolidate those debts, it's still not a really attractive type of loan to be considering. And now if Freddie Mac and maybe Fannie Mae comes along after the fact and does something similar, if they're issuing second mortgage loans at a competitive rate, maybe it's somewhere between 5 to 7%, I think you're going to see a lot of liquidity enter the market. And that potentially has a big impact on housing because we haven't seen a lot of mobility in the housing market, and a lot of inventory hasn't really reached the marketplace because people are sitting on really low first mortgages and they don't want to move. And because of the tight inventories, which we're starting to see some relief of the last month, but the inventories are still very tight, perhaps this is going to only add fuel to home prices, because if inventory still remains tight, people don't actually sell their homes. Maybe they rent it out. But I do think at least you might start to see some mobility where people are draining some of the equity using these somewhat attractive second mortgages and now making the move or transitioning to a smaller home or bigger home or whatever they've wanted to do the last 2 years, but weren't able to financially because they had a good first mortgage and couldn't really tap into the rest of the equity they had at a reasonable price point. So I think this is going to help a lot of people, number one, pay down their high interest rate debts. And everybody has these, or at least the majority of the market does. We see it happen every cycle. People are used to financing lifestyle, and eventually they're able to refinance that debt via their mortgage and provide some relief. They haven't been able to do that for 2 years. So people do feel under some sort of payment pressure, their backs are against the wall. And so perhaps with this type of reasonable interest rate, second mortgage, credit line, term loan, whatever it ends up being, people will be able to free up some liquidity by paying down those high interest rate debt. I think that could be a huge boost to the economy. So although we have been a bit long in the tooth in this bull market cycle, both in housing, equity markets, capital markets as a whole, I understand the bearish sentiment and where everything kind of does feel like the pendulum has swung too far the other way. Be very, very aware of what is going on with this decision by Freddie Mac or whoever else gets involved, because if they do provide reasonable terms and reasonable interest rates on these second mortgages, people are going to get the relief that they need, and it could be a big boost to the economy. And it could keep housing where it has been in terms of home prices, because people might be able to tap into that equity and go out, make a move, put a down payment without selling the asset that they have a great interest rate on from 2020 and 2021. So I think one of the reasons Freddie Mac released a comment about it is I feel like they were testing the market sentiment and seeing how it was received. Something in my gut tells me this is already a done thing and a decision they've already made and they've already worked out the numbers on. So let's keep a close eye on this. and perhaps sometime this summer we'll be we'll be able to provide you some second mortgage options through these Freddie Mac financing programs. So keep that in mind. I hope this video was informative, not only some of the dynamics that go on in making a second mortgage decision, but also how it could impact both housing and the economy overall. Thanks so much. If you haven't already, and if you're unfamiliar, we released an exciting new website, LensEnd.com. It is the first fully automated mortgage shopping experience. You can go on there, see real-time mortgage rates, get an instant analysis. We don't collect any personal information. We don't require phone numbers, emails, none of that. So you can have a lot of fun with that tool. I think it'll give you a lot of transparency on what is going on with interest rates real time, as well as do all the hard math and do all the analysis for you without having to talk to a human. No hassles, no headaches, no humans. I think you're going to find it to be a very, very helpful part of your refinance and home buying process. Check that out at lensend.com, and I appreciate your time. I'll talk to you guys real soon. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.